Good morning. We will pay attention to inventory and consumable stores today. Trading stock. Inventory that was purchased with the intention to sell it at a profit is called trading stock or inventory. Purchases, sales, returns of inventory are accounted for in the inventory account when the perpetual inventory system is used. That means the whole year, every time when the inventory increases or decreases, it will be recorded in the inventory account. On the last day of the financial year, an inventory count will be held to calculate the value of trading stock on hand. So every article in the business will be counted, determine what is the cost price of the article, and determine what is the total value of trading stock on hand. If this physical inventory count do not correspond with the balance in the inventory account, the balance of the inventory account has to be adjusted to correspond with the physical inventory count. Okay, that is very important. Inventory is an asset, and you are not allowed to show an asset at a higher value than what it is really worth. So the amount that will flow into the business cash must be the same as the amount that you record as an asset. So if your inventory account indicates that your inventory is 32,000, and according to the inventory account, there's only 31,000 in the stock, you have to reduce it with 1,000 so that you can show your inventory at the actual amount in the balance sheet. The difference between the inventory count and the balance in the inventory account will be accounted for as an inventory deficit. It's an inventory deficit because you don't know what caused the transaction. If you have a fire, you will have a loss of inventory due to fire. If there was a burglary, loss of inventory due to burglary. If you can't actually pinpoint the reason for the inventory loss, you call it an inventory deficit. We have the following account in the general ledger: the inventory balance at the beginning of the year, and the creditors control is all the amounts that we bought on credit. On the credit side, this is the amount that we returned to the creditors. This is the amount that we sold during the year. We had drawings, and according to our bookkeeping, there should be 39,200 inventory on hand in the business. According to the physical inventory count, there's only 37,800. Okay, if we look at this inventory account now again, according to the physical inventory count, the balance must be 37,800. So it means that we must reduce that balance to the new balance that we calculated with the physical inventory count. Now our ledger account will not balance because we reduce this balance. So I will add up the debit side, subtract the credit side, and the balancing figure will indicate to me what was the loss of inventory. And I will debit my inventory deficit account to create an expense that I will transfer to my profit and loss account. What's very important to remember here is that inventory is an asset. So it means if we want to reduce the asset, we will create an expense for the inventory deficit. So remember, inventory is an asset and we create an expense. Consumable stores on hand like stationery, cleaning material, etc., was not purchased with the purpose of selling. They are used in the business and will therefore be expenses. So every one of these accounts will be debited because it's an expense account. So if we buy cleaning material, we will debit cleaning material. If we buy stationery, we will debit stationery. At the end of the financial year, the value of all this consumable stores on hand must be calculated. If we have any left over, it means that we have to reduce this expense and indicate that we've got an asset, consumable stores on hand. So the expense account will be credited to decrease the expense with the consumable stores that we did not use during the year. The actual value must be transferred to profit and loss. So if we look at the stationery account, we had a balance of 1,600. We have left over at the end of the year 300. The expense that goes to the profit and loss must be the actual amount used during the year. So if we've got 300 left over, we must reduce the stationery account with the 300 so that we can show that the actual amount that must go to the profit and loss for the amount that we used during the year was 1,300. So we have an expense account because stationery, petrol, oil is expenses. What we do in expense, we go and we create an asset account for the amount that's left over. So I will credit my stationery account with 300 and I will debit consumable stores on hand. I credit the stationery expense so that I can take the correct amount to the profit and loss account, 1,300. I create an asset so that I can take this 300 to my balance sheet as inventory. So in the balance sheet, we will show that we've got inventory on hand at the end of the year. That inventory consists of the inventory according to the inventory count after we calculated the inventory deficit, and then all the consumable stores that we've got left over at the end of the year will also be included in the inventory note. The inventory account is an asset that must be decreased if we lost some of the inventory, and we will go and create an expense to show that there's an expense for inventory deficit that will reduce the profits. When we use our stationery or consumable stores and there's left over at the end of the year, it means that I must reduce this expense account and I must create an asset, consumable stores on hand, that I can show in the balance sheet.